Night Stock Charts Live. This is Bob Desmond, and welcome to another Thursday. And big news after hours is we have a $110 billion buyback plan by Apple. They beat on EPS, they beat slightly on revenues, and the shares are up measurably in the after hours session. The expected anticipated market maker move was a move of about $6.50. Actual was measurably, I believe, higher here. Yeah. So option premium sellers, call sellers were wiped out on this one. Not a very profitable trading day for them. And this is why I don't do many earnings trades anymore. So although we did one this week, we did very well with it. Lemonade. LMND, big short squeeze candidate. Love it. So Apple looking good here. And of course, they did the aforementioned $110 billion with a B share buyback. Now, does this change our strategy at all? A little bit. So as soon as I saw the earnings report, I dumped what remained of my short position. We no longer have a short on the triple Qs. Am I bullish? Not really. I'm not in that bull camp. We're going to go over the weekly chart in a couple of minutes, and we'll talk about how we appear poised to close out the week. That's what we do here on Thursday nights. How do we appear poised to close out the week in the equity markets, commodity markets, bond market, etc.? That way, we have an idea of how we're going to perform next week. How do we want to be biased? Not biased. How do we want to be positioned? Do we want to be biased in any one direction? Are we more geared towards commodities? Are we more geared towards small caps versus large caps, etc.? So we're going to talk about that all tonight. Stick around. We're going to talk about natural gas. Natural gas. Nobody wants to talk about it except for, I'll give credit. I always forget his name. Where is it? J.C. Parent. I'll go to his tweet in a moment. So I'm not as bearish as I was a couple of days ago. I am extremely cautious on the market. We'll talk about the whys behind that. But certain events took place over the past 24 hours to make me a little bit less bearish on the market. So let's get to it. Before we begin, I want to talk to you about this off of the Kobisi letter. And it is, my glasses are all foggy. I just washed them. An interesting note, they put out some really good tweets. The U.S. economy's share of world GDP is set to reach the largest level in 2 decades. Interesting stuff. U.S. GDP is now estimated to reflect 26% of the global economy in 2024, according to the IMF. Think about that. We have about, 6% of the world's population, yet with 24% of the world's GDP? Amazing. A decade ago, the country's share exceeded the EU and UK combined contribution, and it's now 5 percentage points larger. So take the EU and UK, put them together, we're bigger than they are. Meanwhile, China's share of the global economy has been declining since 2021. Guess why? And is expected to reach 17% in 2024. The U.S. economy has never been bigger than it is today, and the gap is widening. So all the talk about the American empire coming to an end may be a bit premature. So we have to ask ourselves the question, why is GDP growing the way it is? I would argue that some of it has to do with the reindustrialization of America. I did a video about that. I think it was back in November, about the reindustrialization of America. Basically, the onshoring of manufacturing, or the reshoring of manufacturing, because of what happened during the COVID crisis and the supply chain crisis. So you have what is the phrase that's out there? Uh, like friendufacturing, something like that. Basically, manufacturing done by your friends, not so much the Chinese. So, interesting tidbit to start the conversation off with. Oh, and the other reason why, let's not forget this. Let's remember that Congress has been spending like a drunken sailor since the COVID crisis. The experimental or the emergency spending that we saw after COVID was expected to be temporary. It's still going on. We've never retraced all the way back down to below COVID levels in terms of spending. It's going up higher. So the question then becomes, are we buying our GDP? Think about it. So let's talk about economic. Let's say hello to people as people populate in here. Franklin, welcome. Larry, horse to beat in the Kentucky Derby is 17 Fierceness. All right, that's where I'm putting my money down. FCG. Yeah, we'll take a look at that. I forgot about that one. Actually, I didn't forget about it. It's on my Post-it note here. Can you see that? That's from last week. There we go. I do keep Post-it notes. Okay. Trader Isaac, hello, Bob. Cook doing a Jack Welch and buying back stock to give it a boost. Like, oh yeah. He's got a hoard of cash over there. A hoard of cash. He had to put it to work. It wasn't making him money. TZ Burton, welcome. Jody, the lovely Jody, welcome. Okay, so let's get to it. Let's talk about the economy this week, and then we'll go into the Fed meeting, and we'll talk about gold mining stocks and natural gas. I could care less about Apple, to be honest with you. So, to me, Apple is it's done. What's the new product since Steve Jobs passed away? I mean, Tim Cook has done a great job of building the business out, leveraging their current subscriber base into services. He's doing an amazing job. I'm not taking anything away from Tim Cook, but their R&D team would be hard pressed to come up with a really great new product. I mean, under Steve Jobs, you had the Mac, you had the iPod. The iPod, many people may be too young to remember the iPod before the iPhone. So what's the new product there? A real gangbuster product that everybody has to have. I can't name one. And plus, you have the government, the Federal Trade Commission after them. Let's talk about the economic data so far this week. Inflation at the employment level, hot. I love when my fellow Americans make money. Unfortunately, Wall Street does not. The Federal Reserve does not appreciate wage inflation. We're also seeing wage inflation. We're also seeing housing inflation. The expectation for a rise in prices was 6.7%, actual 7.3%. That's a big, big beat. Consumer confidence, missed. Chicago Business Barometer, missed. So look at it in terms of how the Federal Reserve gives a thumbs up or a thumbs down. This makes them angry, thumbs down. This makes them angry, thumbs down. This makes them kind of sad as well, because you have inflation and you have the barometer for business going down as well. Also, consumer confidence missing. This is all setting up for stagflation. Remember that word, stagnant growth and inflation. Wednesday, ADP report. More jobs were created. Tomorrow we have the Pimp Mac Daddy of them all, non-farm payrolls. But we already have a beat on ADP, and the markets are able to shrug it off and close up higher today. I know this was reported yesterday. Construction spending missed by a mile. ISM manufacturing, that missed. Job openings, this is something that the Federal Reserve really doesn't want to see. That's tightness in the labor market. FOMC, we had that. We'll go to that in a moment. Initial jobless claims came in less worse. That's good to see. Unfortunately, Wall Street doesn't see it that way. Productivity, missed. That's not good. Unit labor cost. So you had productivity in Q1 that missed by 2 basis points. Yet your labor costs went up 7 basis points. Think about it. You're paying more per worker, yet their productivity is declining. So tomorrow we get U.S. employment report coming out, and keep an eye on this one here. Average hourly wages. You want that, if you're bullish on the market, you want that to come in on par with expectations or less than what the street was expecting. That would give a little bit of breathing room for the Federal Reserve. And it sounds counterintuitive. You're probably saying, listen, I don't know, why is that good? Why is our fellow American making a buck? Why is that so detrimental to the economy? It's inflation. Unfortunately, as sick as and perverse as it is, it's inflationary. Later at 10 a.m. Eastern Standard Time, we get ISM services. That's an important number. So a busy week, by and large, indicative of a stagflationary environment. Now, the PE ratio for equities. It's difficult for me to become less bearish on the market, but we have to look at price action, and we have to look at what drives the markets. We look at the Federal Reserve's, not the Federal Reserve, the Fed Watch tool. We're going to go to that in a moment. And you need to take a look at other indicators. Utilities rallying, regional banks rallying. What's up with that? And why does that matter? What does that tell us about where rates are going? It tells us a lot. But you need to be very experienced in the markets. And if you're not, and you don't understand why they matter to where this market goes moving forward, that's why you're here. And we're going to talk about it, because these are our canary in the coal mines for the equity markets. And we can ignore the indicators that the markets are sending us right now, but to our own demise if we're going to remain short and fight the market. So am I saying for guaranteed we're going up in this market? No. I'm saying that today and yesterday were a bit of a game changer for me. So let's move on. Let's play this from Jay Powell. And I want you to pay attention to the pause.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
I'm going to play that again so everybody can hear it better.
Don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter. And I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking. don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Okay. So that was the question. That was the pause. And the markets took his statements as being somewhat hawkish initially. And they sold off, and they sold off very, very hard. And in fact, one of my members sent a message that and that he said that we were closer to a rate hike than we are to a rate cut. Now, we can listen to what he has to say, but we really need to watch what they do. And in the absence during this quiet period, really a quiet period of this Federal Reserve inaction, he's not raising rates, he's not cutting rates. It's a pause. This is now the longest pause in history between a stoppage of a rate hike regime and the beginning of rate cuts. This is the longest period in history. So what do we look at? What do we look at to determine how are the markets taking the statements of the Federal Reserve? Bullish or bearish? Or I should say it this way, dovish, meaning they're betting that he's going to cut rates. Or are they betting that he is going to be hawkish? The immediate reaction by the markets yesterday was to rally. Then they absorbed everything he had to say and they sold off, and they sold off really, really hard, except for a couple of areas of the market. While they sold off their highs, they still closed up. What were they? One that you wouldn't imagine would be up, and it is clearly indicative of a dovish Federal Reserve, and that's the DPST. You can bring up the KRE. We'll bring that up as well. But this is the Direxion Regional Banks Bull ETF, now optionable. I haven't looked at this in quite some time because it was not optionable a few years ago. Now it is optionable. So take a look at this rally here in the regional banks. Remember that a little more than a year ago, these names were in free fall here. Actually, yeah, that's right, here. So now look at them. And you may be asking, what do they have to do with the Federal Reserve and cutting rates? Well, remember why they came under pressure last year. They had way too much in terms of government debt that was not making them any money, and the Federal Reserve raising interest rates was bringing down the value of those bonds. So you had banks blowing up right and left. So when I took a look at the regional bank index yesterday, while the rest of the market was selling off, especially technology, what closed up yesterday? Regional banks. That's signal number one. Signal number two is this. This is the utilities versus the S&P 500. Now, why do the utilities come into play here? We know why the regional banks are impacted by higher yields. It hurts them. So they rallied yesterday. They're betting that there's not going to be any more rate hikes. We're going to get rate cuts. Done. Now, utilities. Why would utilities be up relative to the S&P 500 when odds of a rate cut were beginning to pull back? They didn't believe them. And why do the utilities, why do they benefit from declining yields? Well, what do utilities do? They issue bonds all the time. And those bonds are perceived to be more risky than government debt. So if government debt is rising, well, that means that the utilities need to pay more in interest costs to compete with treasuries because they're not as safe as U.S. treasuries. So if there's an expectation that bond yields are going to pull back, well, what do you want to buy? You want to buy utilities. So let's take a look. So utilities versus the S&P 500, outperforming. They've been outperforming for the past 3 months. How did they do yesterday? Or how are they doing on the month? I should say last month. Look at this rally here. So the regional of the utilities are breaking out. And we're at the highs of the month. And how did they do yesterday? I haven't looked at this yet. They were up, just like the regional banks. There's more. So to validate the dovishness of how the markets perceived the statement out of the Federal Reserve yesterday, we take a look at the Fed Watch tool. And before that presser yesterday with Jay Powell, there was a below 50% probability, in the 50s, I believe, not below 50%, I think, of an ease. Now we're back above 62%. So while September was not going to happen, it was out of contention for a rate cut. It's now back in. So how do we take this information and apply it to the rest of our investment portfolio? Well, we'll talk about the weekly charts of the major averages in a moment, but you need to think about it this way. If the markets are betting on rate cuts as signaled by the Fed Watch tool, as signaled by the regional banks, as signaled by the utilities, then why aren't small caps going to rally? Why aren't mid caps going to rally? Why isn't tech going to rally in anticipation of a rate cut? They should. They should. So this is one of the major reasons why, and I'll go to the other one when we go to the weekly charts, of why we covered shorts today. And we made good money. We're out. Is all right with the world? Not necessarily. I mean, this is the right thing to do. The Federal Reserve's reducing the size of their balance sheet slowly but surely. We're still well above where we were prior to COVID, but we continue to drop down. They're reducing the size of their balance sheet. That's the appropriate thing to do. If they didn't do this, well, the rally in bonds today would have been bigger than what we got. You got it, Jeff. Pete, welcome. I'm seeing more and more companies hitting EPS but missing revenue. Less demand, just higher prices. Maybe consumers are starting to reject higher prices. Well, they are. Just look at Starbucks. Perfect example is Starbucks. No doubt about it. I have an article that I'm going to pull up in a moment. I think I have it up here. Yeah. I have an article that inflation is really hitting companies. And to your earlier question about the miss on earnings and the beat on EPS, well, that's all due to the fact that they raised prices and they did a headcount cut, reduction in force. So a lot of these companies are running lean and mean. Pardon me. So are we out of the woods yet in terms of the market not going down? This is the main reason why I can't get bullish on the market and go to sleep all toasty and comfy, knowing that the stock market is going to be up tomorrow, because what you're looking at here is the yield curve. And when this rises, that is not good for equities. It is very, very bad. And we broke out in April. And so far this month, we are up the first 2 trading days. And I should say we're off the lows of the month. We're up a basis point as of the close of business today. So yield curve continues to steepen. Will I be looking to get short the market again if they do rally it? Absolutely. Will I be watching this chart? No doubt about it. Very, very closely. I'll be watching the yield curve and what it does. When I wake up in the morning and I bring up CNBC, the first thing I look at are the futures and I look at the yield curve. So how soon is the recession? Job market tightens, tightest in 4 years. Well, right now, think about it this way. Let's go back to this tool here. Okay. So there's a couple of ways of interpreting this. You can look at it as a trader and say, okay, do I remain long of equities? Well, we know from history that the first rate cut is usually a top in the stock market, or we're close to a top, we're in a decline because the Federal Reserve is responding to something. There's something wrong out there. So they need to step in and fix it. They don't cut rates when the economy, as I started this off with, is at the largest percentage of global GDP in history. They're not going to do that. So right now for June, no ease. There's no reason for them to cut rates. July, they're not expected to cut rates. But September just happens to be two things. One, a seasonally volatile period. Two, it's the last Fed meeting, I believe, before the election. I think the election, somebody fact check me on this, please, because I don't want to pretend that I know it all. I think the election is on the 6th. Where is my calendar? The 5th. So election day is on the 5th. This Fed meeting is on the 7th. So the last Fed meeting is in September before the election. So if they're going to do a October surprise, they need to do it in September. And if they cut rates and they don't need to respond to an emergency, you're going to see an adrenaline rush in the stock market, and it's probably going to be the blow off top for the stock market, because what that's going to do is that it's just going to unleash the hounds of inflation in this economy. So that's my answer to your question. I hope that makes sense. Okay, let's move on. We did the yield curve. Let's talk a little bit about natural gas. I saw this today. Just to give you some background. I traded a few times the ETF Boyle. Sometimes I won, sometimes I lost. And you could see, though, from trading it, that it's been firming up quite a bit. And of course, natural gas. And then late last night, as I'm watching the markets, I took a look at the commodities market, and I saw a setup on natural gas. It was a higher low, very tight Bollinger Bands. I said, you know what? I bought some natural gas futures, and I woke up this morning, and that call was right. I was up. I did about 14% on that trade. So natural gas has been treating us good this week, and I found it very odd. And I don't let the little placements in media go by too quickly, because I always sense a little bit of how do I say it? Effery, fill in the blanks. It's a family-friendly show. Effery, shenanigans, if you will. So Permian Basin shrugs off zero natural gas prices in Texas. Zero natural gas prices are zero. And I know in the context that they're probably meaning it for the Permian Basin, there's some rationale to it. It's the headline that matters. It's the headline that matters. When you see negative stories like this on natural gas, what's it meant to do in reality? It's meant to jawbone the price of natural gas down lower. Maybe in this person's instance, it's not. But in my mind, doing this for as long as I have, usually right before you get a rally in something, somebody's downgrading it, somebody's beating it up on CNBC, and all of a sudden you realize a couple of weeks later, well, they're probably buying it at the time they were jawboning it down. So I saw this, and it kind of validates my opinion about where natural gas prices are going to go. That's the contrarian in me. They're posting now that there is a zero natural gas price in Texas. Okay, sure. Then I went on to Twitter as I was preparing for the show, and JC Parent had just posted this. These are historically great prices to be accumulating natural gas, but it's the timing here. What the heck did I click? Oh, he spammed me, son of a gun. But it's the timing that will be key here. Okay, so great point. This is an accurate chart. I have my own. So here you have natural gas prices, quarterly view, going back to 1991. Whenever we get in this range, it usually leads to a massive bull run in natural gas prices, a massive bull run. Last time was, let's call it 1992. You saw a nice rally. We did a higher low in 1995. That led to a secular bull market that ended in 2007 in natural gas prices. Then you had the shale revolution. What happened to natural gas prices? Permian Basin destroyed. Then in 2020, everybody stayed home. Whatever the reason was, we retested the support level, rallied yet again on natural gas. We have now since retraced. So, how is natural gas performing? Well, relative to the S&P 500, we'll go to that in a moment. But for the quarter, natural gas is up 15.43%. Yet, we're supposed to believe the Permian Basin shrugs off below zero natural gas prices in Texas. If there was below zero natural gas prices, they would not be up 15.43%. It's simple as that. How is it doing relative to the S&P 500? Relative to the S&P 500, this is just for this month, 2 days, up 1.63%. I don't know what it looks like on a quarter, but I'm interested. Before I leave this chart, yeah, we were up last month as well. Here's the quarter. Relative to the S&P 500, natural gas is nearly 20% higher relative to the S&P 500. Yet, can't make this stuff up. The Permian shrugs off below zero natural gas prices in Texas. What's the value of this article? What's the value of it? I don't see it. Except for manipulation. My opinion. I don't know that to be a fact. Well, Michael, it's a good question. I was watching, as much as I was watching an interview with Larry Fink. He is the CEO of BlackRock, and he was talking about the need for energy is going to double over the next 10 to 20 years. Why? AI, crypto, EV vehicles, etc. That's why their nuclear plants that they shut down, they're reactivated. That's why the price of uranium is going through the ceiling. What is the most common fuel here in the United States for heating, etc.? It's natural gas. It's not solar. It's not, it'll never be solar. It'll never be wind. It's natural gas. So natural gas is, there's a buildup in demand, and you get the weekly report that came out at 10:30 this morning of the weekly inventories report, and the markets took it as bullish. The price of natural gas surged on that report. By the end of the day, I believe we were up 4% on natural gas. Let's fact check that. Well, this is as of today. This is the futures contract, and this looks like it wants to go up higher again. We're both flagging out here. Let's bring up UNG. 5% on the day. So a very, very strong day here for natural gas. And a strong week for that matter. And we have yet to take out last week's highs. Think about it. I don't understand why APPl down from earnings. I saw that. I stopped out of APPl. Was it yesterday? Yeah, yesterday. I stopped. My stop loss got triggered on it, and I was out, along with BHP a few days ago. I haven't looked at BHP. I maybe look at that in a little while, because the mining stocks are starting to come back. Down from earnings. I haven't looked at their earnings. I don't know, to answer your question. I don't know, but I looked at the closing price action today. It does not look pretty, but it may be time to buy soon. But oil prices pull back as well, so maybe not so quickly. All right, so let's talk a little bit about gold. And when I say gold, I use gold in a holistic sense. We're going to be talking more about gold, but when I talk gold, think gold stocks. When I say gold, think silver. When I talk gold, think silver stocks, all in one bucket, all in one big, beautiful bucket, because they're all highly, highly correlated. So what is the perfect petri dish for gold? Stagflation. I mentioned it earlier. We went over the economic data. Economic data this week was fairly weak, yet inflation fairly hot. PCE last Friday, what was it? Warm or cold? It was hot. So from the Kabisi letter, more evidence stagflation is beginning. U.S. manufacturing activity fell into contraction territory again in April. I believe that was last week. ISM manufacturing PMI index dropped to 49.2 from 50.3 in March. 50 is the neutral line. A read below 50 is a sign of contraction. A read above 50 is a sign of expansion. Excluding March, U.S. manufacturing has been in contraction since November of 2022. Think about it. The worst part, prices paid spiked to their highest level since June of 2022 due to rising crude oil, aluminum prices, steel, and plastics. We talk about this every Sunday night. Every Sunday night, we go over the commodities market. We don't wait for the PCE report to come out. We don't wait for the CPI report to come out once a month to tell us what happened 30 days ago. We don't care. We know in advance what that report's going to look like. So if you're not subscribed to the channel, please do so. So continuing on, input costs are surging, adding to more inflationary pressures to the U.S. economy. At the same time, the economic growth is stagnating, yet another data point signaling stagflation. Again, stagflation is the perfect petri dish for gold. If you want to see a stagflationary environment, look at the price of gold post 1971 into 1981. 10-year bull market. And I've gone over that before. And a lot of people think that yields can't go up and gold can go up as well. They can't go up together. Of course they can. They can go up. Why do they go up? And why do people get this wrong? It's because they negative project about interest rates. if you have gold going up with interest rates, all gold is saying is, hey, markets, Federal Reserve, whoever will listen, bond vigilantes, anybody who'll listen, you're behind the curve. You need to raise rates more. Inflation is too hot. You're behind the curve. So the Federal Reserve can raise rates all they want. Until gold breaks, they are behind the curve. That's why they can rally together. What didn't rally in the 1970s into the 1980s, along with yields and gold? The U.S. dollar. The U.S. dollar was in a bear market for that time frame. The dollar, because gold is priced in dollars, must be going down. Most of the times, because I'm going to preface why we had a rally in the dollar and gold and yields for the past over a month now. But that's over. It's done. Sticky inflation mentions on earning calls hits new high as big brands warn about buckling consumers. Okay, so you have earnings that are under pressure. Why? Due to the fact that the consumer's done, cooked. Look at Starbucks. Sticky inflation. Yet, the Federal Reserve is going to cut rates in September? How do you stop inflation by cutting interest rates? You don't. You put gasoline on the fire. Yet that's what they plan on doing. Unless, of course, the economy goes into recession. Israeli warplanes strike Damascus as Iran tensions on the edge. So things are heating up yet again. Proxy war in Syria. This is the approximate reason as to why you had a rally in gold and the U.S. dollar during this time frame between Iran attacking Israel and then vice versa, all that nonsense. We're not going to get into the whys. We're not a political show here. But that caused a bid under the U.S. dollar and a bid under gold because it was a flight to safety. That's, for the most part, over. But if this starts back up again and the dollar gets strong, so can gold. But something happened today. Japan spent an extra $22.6 billion to support yen in its second intervention this week. What does that mean, Bob? What does that mean? Well, it means that gold went down in yen terms and went up in dollar terms. Japan's history of supporting the yen, it's kind of a mixed bag, but by and large, their intervention in the yen has had a longer-term bullish effect on the Japanese yen. Now, Japan is an exporting nation, so they don't want the yen to get too expensive because that makes their goods more expensive. But they have an inflation problem in Japan. They have a demographics problem in Japan driving up wages. So they need to do something. So they need to strengthen the yen. Their actions within the past month, their first rate increase in over 20 years, along with the intervention in the Forex markets, that means that they're beginning to grab the bull by the horns in terms of inflation. There's only one problem. It's bearish for the dollar. But that's bullish for gold. So here's the weekly chart, U.S. dollar. And we have a bearish key reversal. We haven't had a new closing high on the U.S. dollar, and this will now be the third week. And you can see how it responded today. Absolute bloodbath. We had broken out on Tuesday, did a retest on Wednesday, and this is why one of the primary reasons why I remain short the market. In addition to the price action of the equity market, and I also sold half my position in silver because I thought gold was going to continue to break out. The flying element was that I didn't know the Japanese BOJ was going to intervene in the Forex market, and this is a failure of the US dollar breaking out. So it's looking pretty bearish for the dollar, and that is very, very good for gold and the gold mining stocks. So let's bring up the gold mining stocks. That's too noisy. Look at this. Look at this chart. Quarterly chart. We're early in the quarter, only 1 month in. But we have a double bottom setup, a higher low on the gold mining index. I think that this is going probably to new all-time highs within the next 2 years. So you really need to be thinking about getting long of these names. And if we take a look at GDM relative to SPY, they're still down. Well, this is only 1 month. Let's go to a quarterly view. Quarterly, the gold mining names, the gold mining sector is outperforming the S&P 500 by over 10%, nearly 10.5%. That's a tell. That's telling you that the gold mining stocks have relative strength. Now, here's the beautiful part about this story. It's still very early in the game. Gold just broke out to new all-time highs only, what, a month ago, month and a half? This is still early in the game. The gold stocks have yet to really run. So we remain very, very bullish on the gold stocks. I'll probably be buying back my silver position as soon as tomorrow if the dollar continues to break down. Bob, did you see gold earnings? That's Barrick Gold earnings. Which earnings was a beat, and how do you like this gold miner? Barrick is a premier senior miner. I did not, to answer your question, take a look at their earnings. When did they report? Nice day today. Oh, this is the correlation. No, it's not the correlation. This is the correlation. Good day today, up 1.16%. So it looks pretty good. And I want to leave you off with, I'm not going to go into all the closing price action of the week. I don't have time. I want to get to some chart requests. So it was yesterday. So it makes sense. Negative reaction, then positive today. Okay. Thank you. All right. So 10-year yield down on the week, bullish for equities. What do we do today? Bearish day, bearish key reversal bar. Bond prices, they should be up, and they are up on the week. These look like they want to go up higher. So I'm expecting lower yields, rising bond prices. That's equity bullish, unless, of course, yields just drop like a rock. That's not good. But if they drop down incrementally, that's bullish for equities. The tip market. This should be firming up now because the Federal Reserve, for the most part, is stoking the flames of inflation. And the tips were up today. These should go up higher. I'm now becoming more bullish on tips. Now, as for the dollar, we already went into it, but I want to take a look at the euro weekly chart up. It's okay. It's not, I wouldn't say go buy the euro, but it's up. So if you have the euro up along with the yen, that is very bearish for the dollar. The dollar can't go up with both the yen and euro up. Can't happen. Volatility, weak. Dow Transport, consolidating. Dow Jones Industrial Average. On a weekly chart, this to me looks like a bear flag setup. On a daily chart, we came close to breaking out today. So we're going to know very, very soon whether or not we are going to continue to break down here, or is the correction over and we now begin to rally back and put in potentially new all-time highs in the equity markets. The problem is that earnings, we're just as expensive on a PE basis, trailing PE basis, as we were prior to earnings. In fact, you could argue that equities are unchanged and we're actually maybe even down relative to when they reported earnings, and equities are more expensive now. So while I can argue for a rally in the equity markets, I am also arguing that you need to be very, very careful with your stops. Very, very careful. The first sign of trouble, out. Just like it was yesterday. I had a stop loss in on BHP Bulletin and a stop loss in on Apache. And thank God I did. BHP continued to drive lower. APPl, basket case. So stand by your stops. Stand by those stops. S&P 500 weekly view, down on the week still, despite today's price action. Down volume, though, very, very light. Daily view. We broke out today. I'm going to call this a secondary resistance level, not a primary. What's the primary look like? Really, it looks like this. If we close back above 506.74 on the SPY, we're going up. Right now, I don't want to be short. I don't want to be long. I want cash and gold stocks, silver. That's it. And my blanket. Now, our short that we covered was the triple Qs. We made money. But here's the daily view of the triple Qs. This is why I could not, after Apple's earnings, remain short the market. So yesterday was extremely bearish price action, horrific price action. We should have continued down lower today. We didn't. So we could fight the market. We could say that there's no way that this stock market could go up higher, or we could take the signal by the market and say, okay, well, what am I going to do? Can't fight it. So you got to trade the market that you're given, not the one that you want. The one that we wanted was one that was pulling back, and we could profit from the short side. Today, for the most part, the market's negated yesterday's price action and now threatening a breakout. I think that if we break out and close above let's call it 430, I'd be a buyer of equities. I think we move up higher. I think you got to watch AI. This is no longer a Magnificent Seven stock market. Forget about that. It's all done. Tesla, all those names, Meta, all those names, forget about them. I don't care about Apple. Apple means zero to me. It's all about NVIDIA. It's all about SMCI. It's all about AI. AI, AI, AI. I mean, even NVIDIA yesterday, well, it did close down yesterday, but it was up for a good portion of the day before the presser with Jay Powell, but up over 3.33% on the day, and on the quarter, we're actually down on the quarter. That's right, because we corrected off. So I think that we are going to press up higher. I think we're going to close up this quarter above $1,000 on NVIDIA. Semi-sector, still down on the week, but if they recover, the market's going up. But I don't think that it's going to be the same names that are the big players. I don't think it's just going to be tech anymore. I think you're going to see more industrials. If yields pull back, you're going to see small caps, mid caps. They're going to begin to participate in the market. Not so much Magnificent Seven. I think that's all done now for this cycle anyway. All right, let's do some chart requests, and we will call it a night. All right, we'll be using TrendSpider. Folks, if you're not using TrendSpider, you're missing out on automated technical analysis, automated trend lines, etc. I'll demonstrate it tonight. There's a link below. Get at least a 30% discount, 35% discount with my discount code. You may even get more because they're always running specials. For the lovely Jody, this is a monthly chart of Starbucks. Now, I didn't draw these lines. This is the algorithm. Click of a button. So we bounced off of support. I don't think that we are done going down here. I mean, that earnings report was not bad. It wasn't horrible. It was the nuclear holocaust of earnings reports. So I'm looking at a price target down in the mid 60s, around 68 before all is said and done on Starbucks, especially if this market rolls over. This is going down and going down hard. If the market begins to rally, you make it a rally off of the support level. I think that ultimately we roll back over. Let's take a look at the weekly chart. I think that we need to touch 67 bucks a share. I think that we need to go there. And when you take a look at Starbucks, it's on my watch list as an extreme oversold stock. And I have an infographic that I put together. There's a link below in the video description area that shows you my step-by-step process for entering extreme oversold stocks. So it's free. Take it. So for yours, keep it. Now take a look at RSI. This was at 17 yesterday, maybe even a bit lower. Now it's only at 19. I'm not interested in this. I want to see this roll back over, head back down to the mid 60s before I got involved with Starbucks. So I would avoid this right now. You may get a rally here, but I think that ultimately it's going to get smacked down and it's going lower. I need to go to the members area. Oh, and I had somebody try to join today, and they sent me an email. The membership right now is closed. So I have an issue with the membership software and PHP database. I have somebody working on it right now. So to me, it's all jibber jabber. All right, Jeff. Oh, Jeff, you have a couple on here. I don't think I went over. All right, let's do this for Jeff. Jeff, let me know. You still interested in DJT BMY? BYON for Jeff. Beyond. This is another one that's an extreme oversold stock. This appeared on my screener. Yes, I'm interested in it. What did I do? BYON. RSI. Oh, it rallied today. All right, so it's not as oversold as it was. Did we hit historical support? No. What am I missing here? Why did this thing pop today? All right, so on this chart here, in dashed line on a monthly chart. I have quarterly support below. It bounced off of quarterly support. Would I be a buyer? No. I think it goes lower. You may see a rally here, short covering rally, but I think that ultimately it moves lower. It's not a short. SoFi. Let's bring it up here. Monthly chart. They had a really good quarter last quarter. Not so good this quarter. But for the month, it's up. For the week, it is down. I don't think that you can buy this until it breaks out. And that could take a while. All right, so our alert set it and forget it. If you want to buy some down here at this lower band of support, that's fine too. Mike, I just popped in the chart for you for future reference. CVS. This is dead money. I mean, there's really not much to talk about here. I wouldn't short it. I wouldn't buy it yet. What is RSI? CVS. $13.56. Interesting. I'll be looking at $50 a share as support. I wouldn't touch it until then. And the key to these trades is to average in, leg in, average down. I know that's supposed to be a no-no in the investing world. When you're buying extreme oversold stocks, you average in. Okay, so that's CVS. Franklin, did Franklin have one? FCG, right? FCG. This is one I was bullish on the last we spoke, and I think we spoke about it over the weekend about being bullish on natural gas, and FCG has not panned out. Has not panned out. Bad week this week. What did they report? Earnings? I don't have any news on this thing. Oh, this is a trust. It's a trust. That's why. I'm very surprised to see this, but I'd have to say avoid right now. Avoid it. I wouldn't short it, but I would avoid it. I'm seeing more and more companies hitting EPS. I think we went over that already. I sent you out the link. You're welcome, Franklin. So far, you're looking at around $6. Depends upon how long you get down there. Between $6 and $6.30 per share before you start nibbling, then add more on the breakout. And that's it, folks. Everybody have an awesome night. Jody, you as well. Franklin, have a great night. Hit the like button, subscribe. You know the deal. Thank you for being here. Have a profitable trading day tomorrow and have an awesome weekend. And I will talk to you soon.